threat to impose 100% tariffs on all countries that purchase Russian energy, including China.
Well, I never said a percentage, but we'll be doing quite a bit of that. We'll see what happens over the next fairly short period of time.
President Trump responding to speculation about a possible 100% tariff on imports from countries buying Russian energy. His immediate focus is India, but could China be next? Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Trump says he'll raise tariffs on India very substantially, while signaling he's close to extending the trade truce with China, which, by the way, is a bigger buyer of Russian crude. India racing to contain the economic fallout from Trump's tariff threat, which is also complicating the RBI's interest rate decision today, with some economists now expecting rate cuts to come sooner. Asian markets are showing resilience in the face of tariff rhetoric, but Ecaterina Bigos from AXA Investment Managers flags risks ahead, including weakening trade and softening domestic demand. Plus, the CEO of Indian technology services giant Tech Mahindra joins us to discuss the impact of trade tensions and how AI is threatening to reshape the business model. Let's get straight to our top story. President Trump further ramping up tensions with India over its Russian energy buying.
We do very, very little business with India because their tariffs are so high. So India has not been a good trading partner because they do a lot of business with us, but we don't do business with them. So we settled on 25%, but I think I'm going to raise that very substantially over the next 24 hours because they're buying Russian oil, they're fueling the war machine. And if they're going to do that, then I'm not going to be happy.
Trump's 24-hour countdown coming as Prime Minister Narendra Modi's top aides are set to head to Moscow, underscoring his commitment to relations with Russia. Meanwhile, India is also racing to contain the economic fallout from the threatened tariffs, which has left officials in New Delhi shocked and unsure of how to respond. The uncertainty is putting the RBI's rate decision today front and center, with some economists now seeing rate cuts coming sooner. For more on all of the factors at play by the central bank, let's bring in our South Asia economy editor, Ruchi Bhatia. Ruchi, first off, how do you think the RBI can make sense of this all?
Oh, this is going to be a tough one for the RBI, Haslinda, because remember, till about August, after the last 50 basis point rate cut decision, the expectation was that the central bank perhaps will hold from here on. But in the last, couple of months, a lot has changed. First of all, you have inflation easing well below the central bank's, target level, which was 4%, and it's been down for last 5 months in a row, coming in at a almost more than a 6-year low for the month of June. And on top of it, you have Donald Trump really ratcheting up the tariff tensions as well, and now saying that he will look at putting substantially higher tariffs on India. And this is going to impact growth a lot. We are already growing at about 6.5% for this year. And on top of it, there are expectations that the tariff tensions could shave almost another 30 basis point off India's growth. And that would be a big worry for the RBI. Yes, they focus in mostly on inflation, but inflation is in control. We have seen good monsoons this time around, and on top of it, a good sowing season as well. But growth is going to be the big worry. You heard Prime Minister Narendra Modi also a couple of days ago saying that we should focus on buying more locally. We should look at spurring domestic economy much more. And this is coming in at a time when global tensions and global uncertainty is really now weighing on the minds of policymakers. So this is going to be a tough one for the RBI. In fact, if you look at our poll itself, out of the 35 economists surveyed by Bloomberg, more than 12 economists are now saying that they're expecting a quarter point cut by the RBI in this policy itself.
We know that Delhi is trying to manage the fallout. The question really is, how is Delhi going to do that? Is there a sense as well that officials are unsure about how to deal with Trump?
I mean, I would say officials are unsure, they're jilted, they're shocked. In the last few days, the kind of commentary that has come in from U.S. President Donald Trump, where he's called, India indifferent to the plight of Ukrainians, the fact that he's called the tariff barriers obnoxious and India's economy dead, that is very unlike of the kind of warm relations between Trump and Modi that we had seen at one point of time. And officials really don't know how to respond to these kind of overtures from the U.S. president. In fact, one of the officials, Haslinda, that I was speaking with said that the latest turn of events is akin to a verbal slap of sorts, and this means that the relationship between India and the U.S. are definitely under strain. And this is coming in at a time when India said that they will continue to pursue trade talks with the U.S. But one thing is very clear: there is no such template to deal with this kind of a situation. An official told me that the U.S. president's conversations and the comments about India in the last few days are almost he's been very vocal, he's been blunt and rude, and that makes it even more harder for New Delhi to figure out as to which way they should go. My sense is that Indian officials will bide their time. They will wait. They will figure out as to what needs to be done, and they will let the dust settle in this issue. Having said that, they're also talking, there is going to be a delegation that will come on the trade side to India on the 25th of August. They're also talking to exporters as well. And in the next few days, we will see how New Delhi looks to respond. But New Delhi so far has been defiant. They've said that they will continue to buy Russian oil because of the needs of the Indian economy. So let's see where things are headed from here.
How quickly friends turn to foes. Our South Asia economy editor, Ruchi Bhatia there. And of course, subscribers can also turn to the terminal for more of our RBI coverage. T-Light Go is your function and the latest updates, plus commentary, analysis from our expert editors. Now let's get more perspective from Ecaterina, Bigos, CIO for Asia, ex-Japan, co-investment at AXA Investment Managers. Ecaterina, good to have you with us. We know that India is looking at perhaps tariffs higher than 25%, which is already very high compared to other peers. I'm just wondering, does that change your calculations and your expectations from India's growth and what the markets might provide for investors?
Yeah, certainly. This complicates, I think, the India growth trajectory. Even at 25% tariffs, as you've heard already, I think the impact on GDP could be anywhere between 0.5% to 2%. But also the challenge is the secondary effects. And I think when we look at the tariffs across the Asian economies, they stand anywhere between 20 to 25. India stands at 25, and China currently is at 42, with, again, possibilities of the 42 going a bit lower, again, depending how the negotiations go. So it leaves India at a high level of tariffs. So when you look at relative comparison to Asia and the ambition of India to become a lot bigger player in manufacturing sphere, I think that provides a challenge. The other element, of course, considering you can say that India is somewhat insulated from direct kind of exports to the U.S. is much more domestic oriented. But all of these developments do have an impact on sentiment and ultimately labor market, and obviously repercussions on the consumer or domestic demand that was sustained somewhat in a positive trajectory so far this year.
So what kind of hit do you think India will take? Because as you indicated, when we speak to the CEOs of Indian companies, they keep focusing on the fact that India is a domestically driven economy.
Yeah, it is. I mean, as I said, that insulates it to some degree, but that doesn't completely shelter the economy from the impact. And yet the secondary ramifications are complicated. I think again, have impact on the broader consumer sentiment, which again, India has relied on consumer sentiment. And also not to forget that post-COVID, India had significant fiscal stimulus. When you look at where it stands now, it's keen to consolidate that fiscal position and improve the macro stability, which again is a shift to what you had the last couple of 2 or 3 years. When you look at the monetary policy, and obviously we've heard the commentary before, inflation is behaving, but not to forget that India has always had inflation that has been higher rather than lower. So again, the risks are two-sided. And when you look at RBI, they already front-loaded 100 basis points of cuts. So I think they have to play quite cautious in how they move going forward. Of course, an increase and escalation of trade tensions between India and the US will obviously leave RBI with the decision to potentially accommodate the growth. But again, I would say at the moment, the situation is stay come out somewhat neutral and see how it develops.
Yes, the RBI has front-loaded, but there's a strong case for the RBI to keep cutting rates. We have the Fed, for instance, expected to cut rates as soon as September, and we have tariffs going higher from 25. It does seem that it should be cutting rates today.
I think that's, again, the central banks generally don't react on immediate information. They have to look at an aggregate data that's coming through. And I would say a cut is not in the data at the moment. Of course, there are risks that are two-sided. Of course, the escalations can go higher or tariffs could go higher. But there's a scope for an amelioration of this. Again, this is not, as we've seen in the case of China, a bilateral engagement between the two economies could lead to a de-escalation, which, again, could be positive. And then, of course, we have to look at elements of inflation. As I said, inflation is not generally doesn't stand at 3%. It's quite uncommon for India to be in that position. Again, we've heard that weather effects have been positive this year and some elements related to that impact from oil prices. But all this could change. So again, RBI, I don't think will be in a position to cut and accommodate at this meeting. But of course, the escalation of tariffs could move the RBI to cut earlier. The views are that they certainly will move another time this year, but towards the latter part.
Even before the tariffs, international investors were making an exit from the Indian market. Would you think that the current situation, the current picture would accelerate the exit of foreign investors?
The India had, prior to this escalation, had already going through the structural challenges. And I've said, I think, from the macro point of view, from the fiscal point of view, and also from kind of the demand and growth drivers in the Indian economy. So this is, of course, is an additional impact, but trajectory has shifted out of India favor. And of course, the discussions or negotiations between China now taking front footing and being more positive. And I mentioned earlier on relative basis, again, currently at 42, China looks incredibly better relative to where India could stand at. And when it comes to that, ambitions for India to take a larger manufacturing share is probably somewhat put on the back foot by this kind of tensions and uncertainties. Again, companies will be unlikely to take that risk to take manufacturing out of China into India when the tariffs are somewhat at the same levels, and also when the geopolitical tensions are somewhat more acute as we stand in current stage.
Tariffs are making it complicated for all central banks, including the Fed. When the Fed met in June, there was less than 1% chance of a rate cut. And now, 2-3 months later, we're talking about, a 90% priced in for September. Fundamentally, what has changed?
Well, I think the data has changed. The market has shifted the pricing rate of rate cuts quite significantly, but data has changed. We've seen the labor market and the revisions in the labor market are quite significant. And then what other things that has come throughout the July, we obviously seen the inflation behaving. Again, arguably, we could say the front loading has played a role in it, but it seems that it gave some confidence to the Fed that this inflation will be transitory. So again, some level of inflation is expected to come through, but I think Fed will probably be comfortable if this is deemed to be transitory and tariff related. And also what we've seen is the labor dynamics. We've seen the wages in labor, again, the wages kind of coming down, which is reassuring the Fed that the core inflation is not gonna move. We saw also some movements in the rentals, which are going to have been sticky over the couple of years. So again, the dynamics and inflation have been quite positive, and the revisions, and again, a weaker labor market is certainly leaves September as a live meeting for the Fed.
And of course, we heard from Trump just this morning that he's looking to name Powell's replacement by the end of the week. Are you nervous? How nervous should the markets be?
Again, it's a replacement, but they will wait till May of next year when his term expires. Again, it's not. This is not an indication of firing. I guess he's proposing it. He's preparing for the May of next year. I think the Fed independence still stands somewhat as a key element of the U.S. economy, and I think the investors' confidence in the U.S. markets.
Ecaterina, hang tight. Ecaterina Bigos with AXA Investment Managers is staying with us as we get her key market calls in Asia, including why self-sufficiency is a key part of her outlook for China. Keep it here with us. This is Bloomberg. President Trump says he's getting very close to a deal with China to extend a trade truce that's set to expire August 12. Trump told CNBC the U.S. was getting along with China very well, while downplaying the idea he was eager for a meeting with President Xi Jinping. Trump says he only wants to meet Xi as part of an effort to conclude trade talks. Ecaterina Bigos from AXA Investment Managers is back with us. Can't believe that we're saying this, but cautious optimism when it comes to China.
Yeah, well, indeed, I think China has weathered this trade tensions fairly well, and I think part of element is that policymakers over the couple of years have made conscious decisions to diversify supply chains, kind of lean into more self-sufficiency. They looked at creating a lot more short consumption. We've seen policy shift into that direction. Also, we've seen technological leadership, which has taken forefront at the beginning of this year, which has led, again, and not to forget, China has been resilient, has been performing, but again, it's selective, is not across the board. We still look at sectors, tech, the beneficiary of tech. When you look at and supply side reforms have scoped to obviously improve some of that broader market behavior, but the broader market is still subject to deflation. Again, deflation needs to be addressed, and that's a key part for the broader market to sustain a recovery.
Can we expect a strong China market? KKR came out to say, yes, there is deflation, but, the market will remain strong.
And again, it's selective. Of course, it is, and we've seen the resilience, but again, reiterating the point, and it's the same thing for the US, it's the same thing for China, in ASEAN and Asia. It's not, the resilience has not been uniform. The resilience has been very focused on sectors. And our view, as we go into the second part of the year, these are not periods when everything is performing. These are more markets for selection, sector selection, country selection, but also security selection. We need to be careful of and cognizant of the companies and sectors that potentially are beneficiaries or potentially could have impact from all the geopolitical escalation and certainly trade tensions that are kind of manifesting at the moment.
What I'm hearing very clearly is bifurcated outcomes. You have to look at certain sectors, certain economies. How are you looking at winners and losers from the tariffs that we're seeing out of the U.S.?
I think that it's fair for Asia. I think the developments somewhat are more positive. And as I said, for ASEAN, placing the tariffs around 20% again is not ideal, but it's certainly a de-escalation to what it was before. For China, again, the hopes that tariffs would go down from 42%. Again, not to forget that 42% includes fentanyl, which can be easily addressed. So again, China coming down lower from where it is at 42, again, leaves China in a very competitive position when it comes to manufacturing. Again, China has a very competitive position already. And again, staying at the tariffs that below, or 42 even is competitive already, but below 42, I think will keep China in a very good position and resilient going forward. Again, Japan and Korea, they had lower tariffs on autos, which is positive. And also not to forget that Japan and Korea part, and Taiwan including, that part of the supply chain for AI, which AI again stays and has been again proven by the earnings in the US, it stays the focus for investors and certainly for a lot of companies that AI development.
It is still a weaker dollar environment, and the dollar expected to go weaker from here, given expectations of rate cuts by the Fed. Where do you see the biggest opportunities on the back of that?
I think the weaker dollar, it's important for Asian economies broadly because, again, they do have it gives them a little bit more room to maneuver when it comes to monetary policy. I mentioned earlier, India, all the Asian countries, with exception of probably Korea to some degree, and China, if you want to take the broader scope, they don't have fiscal room. And when it comes to eating the growth from the impact of tariffs that we've seen, which will have, again, in the second part of the year is expected that the front loading, the transshipment will be unwinded and will have, again, an impact on growth. The only kind of game in town for the Asian economies is the monetary policy. And a weaker dollar still gives them a bit of room to maneuver and help the economies to kind of go through this period of uncertainty.
How about the outlook for earnings? Because that's key for a lot of investors.
Yeah, okay. Well, earnings, it depends. Again, earnings are much more driven by elements that are related to AI. I say the themes that are supported, secular themes that are driving the demand, that's driving the earnings. And I would say the policy is also an element that we need to pay attention. And again, I would say policy, when it comes to policy room, China is where the policy room is still at the moment, and where China leans on that policy will have ramifications on positive performance. Again, the weaker dollar, it's not so much on earnings one-to-one. We have to look at elements that are driven by demand for certain products, as I said, and where the policy is leaning to support the growth.
If you take a look at a 12 to 24 month perspective, I'm wondering how your portfolio should look like, and have you made changes to how you're deploying your resources, your capital?
No, ultimately, I think with the earnings seasons, when you look at U.S. Earnings seasons, has again testified that tech exceptionalism in U.S. is still alive. The hyperscalers are still investors and growing, which again gives scope for that U.S. leadership. But again, we need to be cognizant of that narrow for at the moment performance. When you look at the broadening of earnings cycle in the U.S., certainly the Fed decision is a key catalyst of that. And again, I want to iterate a Fed decision that is not recessionary. Again, we don't need to see significant weakness, but Fed preempting potential weaknesses and cutting, I think, is positive. We've seen historically, empirical evidence shows that markets tend to perform very well, and you can argue that's kind of a beta market where a broadening of the earnings cycles will materialize. We also need to pay attention to the fiscal or the one beautiful bill, which had a positive implication on deregulation, particularly for financials. Industrials are starting to benefit from that reshoring activity. We need to look at a weaker dollar, which is benefiting some of the exporters in U.S. So a lot of the dynamics are crystallizing or taking shape in the U.S., and we need to pay attention to those. In terms of Europe, again, this is reiterating the point that we made earlier. Again, the fiscal stimulus in Germany is going to provide and differentiate those that are going to lead a lag. So places like industrials, defense certainly stand to benefit. And I say for China, I've talked about policy, self-sufficiency, technological leadership, and of course, a de-escalation of trade tensions could provide that lift or beta rally for the China markets.
Ecaterina, thanks so much for that. Ecaterina Bigos, CIO, Co-Investment Asia ex-Japan at AXA Investment Managers. Let's take a look at how Asian benchmarks are looking at this point in time. We know that it was a choppy session in the U.S., and that's possibly going to impact how we trade here in Asia. In terms of the currency market, we have the Japanese yen trading versus the USD at 147.39. It is up about 0.1%. Still to come, we'll talk about the risks facing India's IT sector and how they're positioning for AI disruption with one of the leading players, exclusive with Tech Mahindra CEO Mohit Joshi, coming right up. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on the Indian rupee. Yes, it is a weaker dollar environment, but it's also a weak rupee environment, trading near record lows at this point in time. That's on the back, of course, of concerns about those tariffs, Trump wanting to raise those tariffs significantly from 25% that it currently stands at. And it's also about the exit of foreign investors from the Indian market. Take a look where we are in terms of the Indian rupee, 87.73 right now. And it's up a marginal, a tenth of 1%, but still trading close to record lows. We're keeping an eye in India on the RBI. It is set to make its decision today. Chances are it will stand pat, but there are I guess, reasons for it to actually cut rates again. It has front-loaded, but given where we are in terms of tariffs, in terms of what is expected, in terms of growth for the country, which economy which is weakening, there is reason for the RBI to actually make a cut. That's what some economists are saying right now. The RBI rate decision coming in about 1 hour from here. Currently, the Indian rupee, 87.72. Now to some of the top corporate stories we are tracking. Advanced Micro Devices is facing uncertainty in China. The chip maker, second only to NVIDIA in AI processors, says predicting its return to the Chinese market is tough, despite a strong overall AI outlook. AMD declined to forecast Chinese sales of its new Instinct MI308 chip designed specifically for the region. That hesitation sent shares sliding about 5% in after-hours trading. Amazon will offer OpenAI's latest models to customers on its Bedrock and SageMaker platforms. OpenAI says the newly unveiled models can perform complex tasks like writing code and looking up information online. Until now, Microsoft was the only cloud provider reselling OpenAI software, and advantage that has helped its Azure division grow faster than AWS. Now, staying with tech, shares of German auto chipmaker Infineon climbed in Frankfurt as the company said it would take less of a tariff hit than expected, while also forecasting stronger margins. CFO Sven Schneider told us more about their strategy in the key Chinese market.
The number one position we are enjoying in China is a very strong one, which we are also defending. How is that possible? First of all, you have to have the right products. Secondly, you have to continuously invest into innovation. And we have here some very good examples on very new technologies, but also on pretty mature technologies like low power, mid-high power MOSFETs, where the next generation brings our customers 20-30% efficiency gains. The product to system approach, where we are not simply selling pieces and components, but a full system to a customer. These are things which keep us at a distance to international and also Chinese competitors. But you are absolutely right. The speed with which innovation is happening in China on all ends is mind-blowing. We are responding to that very successfully. That's why we are designed in not only in international, but also in the top leading and emerging Chinese OEMs and tier ones. But we have to keep going. And I also have to confess, and that's no news, we have said it repeatedly, there are also certain product categories, we call it commodity products, low power products, where we are losing intentionally market share, given that the business is no longer profitable enough for us. That's also part of the journey, but enjoying the broadest product portfolio is a very, very big differentiator for us going forward.
And another part of the journey is not only innovation for you, it has also been inorganic growth, acquisitions. I'm thinking of Marvel Technologies over in the United States. When you think about the long-term strategy at Infineon and you think about other acquisitions in the future, what kind of category of activity is still missing in your portfolio? Where would that come from?
So first of all, I'm happy to share with you that the Marvell Automotive Ethernet acquisition, after a pretty short time, has received already all regulatory approvals. So we expect this transaction to close in the near future, which is good news. It strengthens our microcontroller business on the automotive side, but also beyond automotive, it opens new opportunities for Infineon in adjacent fields like humanoid robots. So that's very positive. M&A is always and has always been an important part of Infineon's growth journey: International Rectifier, Cypress, GaN Systems, Marvell, and we will keep looking into opportunities. They have to fit, of course, clear criteria: strategic fit, financial fit, very important, cultural fit, because many transactions are healthy and good, but they do not materialize because culturally it doesn't work together. And of course, we are looking into areas, for example, to mention sensors or software, where it could be interesting to enlarge our portfolio even further.
That was Infineon CFO Sven Schneider speaking with our colleague Oliver Krug. And now to a Bloomberg scoop. Sources say that OpenAI is in early talks for a secondary share sale that could value the company at around $500 billion. Investors, including Thrive Capital, are said to be looking to buy shares from current and former employees. OpenAI's previous valuation stood at $300 billion in a $40 billion financing round led by SoftBank Group. And now this explosive growth in OpenAI and millions being invested by the likes of U.S. tech giants Microsoft and Meta highlights the widening gap with India's tech sector. While India is making strides in AI, it's lagging the U.S. and China in terms of infrastructure, talent, and overall ecosystem development. Our next guest runs one of India's largest computer services and IT firms, and his company is making big bets on AI-led growth. Joining us exclusively, Mohit Joshi, CEO and Managing Director of Tech Mahindra. Mohit, good to have you with us. We've been talking about how AI is reshaping the tech space. I mean, is it expected to reshape the way it's done in India? What are you seeing?
But look, sorry, I missed part of your question, but I feel that AI is obviously a key enabling technology that is really transforming enterprise technology landscapes. I feel the opportunity for the Indian IT services companies, right, is really to help large enterprises make the leap from this being sort of a technology in the lab or at a proof of concept stage to wide scale adoption. And the opportunity really is to help them become more productive, but also to help them from a revenue side, right? If I take a look at what we have done from a TechM perspective, we have actually built a large language model from scratch in Hindi. Then we built one together with NVIDIA in Bahasa Indonesian. But really, our focus is on large-scale enterprise adoption for our customers, which we feel will be a gigantic opportunity for enterprises and for our business.
It is about disruption. How will it disrupt the way technology is done in India? How will it disrupt the industry? Because we know that C.P. Gunani, the former CEO of Tech Mahindra, has come out to say that there'll be less reliance on headcount and that the Indian IT sector has to move away from that.
So look, I think that bit is true in the sense that AI will help drive a significant amount of productivity, whether it is for our developers, whether it's for our architects, or indeed at the contact center as well. Having said that, this is not a fixed fire, right? If you look at enterprise technology spends, they have gone from maybe 1 to 3% of budgets about a decade ago to now maybe 7 to 10% of budgets, right? So the overall enterprise IT spend will increase, and that should take into account the greater productivity that we are seeing from our developers and from our contact center agents. The reality is that there should be an AI-driven boom in spending in enterprises, because enterprises, while they have done some work, right? If you take telcos, for instance, there is some work that has been done in terms of developer productivity, but enough opportunities still exist from a revenue expansion perspective, from a customer experience perspective, that we do feel that this will be a significant tide lifting the entire industry. And obviously, given the work that we're doing from a TechM perspective, should be hugely positive to us. I do feel that the whole way this question has been framed, right, whether the Indian IT services business has lagged, is really a little bit misleading, because at the end of the day, we are not model developers. We have done some work in model development, but more as a proof of concept and to prove that the intellectual capacity does exist among our teams to build a large language model from scratch. The reality is that we play more in the enterprise space. And so the opportunity for us is to have enterprises really adopt this technology, and more importantly, get the revenue expansion and the cost reduction that they would expect. We're really not competing with the OpenAIs of the world. We're really competing to help enterprises adopt these technologies more efficiently.
But given AI, are job cuts inevitable? We saw TCS cutting jobs, 2% of its workforce, 12,000 people, mid as well as higher level workers. Is that inevitable?
Well, look, I think, first of all, can't really speak to the TCS situation, though their CEO was at pains to stress that this was not really AI driven. This was more driven by the new demands that they're seeing from our clients. And I do feel that the work really is being done in our company and other companies to educate and train the workforce. We have now trained more than 80,000 of our employees in AI technologies. And clearly, the work that we have done in model development itself proves that the intellectual caliber, the intellectual capacity is there in the teams. We also understand industries really well, whether it's banking, where you've got AI use cases in client onboarding or anti-money laundering, whether it's telcos, where you've got significant opportunities in network optimization, ARPU increases, customer churn reduction. So I feel this combination of reskilling and a deep understanding of our clients should stand the industry, in a good stead. The final point I'll make is AI adoption is not going to be automatic for our clients, right? There is a significant body of work that needs to be done in terms of modernizing and optimizing the client's estate to really help them, get the full benefit of AI. If you've got a very fragmented application landscape, if you don't have a common data stack, your ability to use AI will be very limited. And I feel that is the opportunity for us and for our peers. And if we can do that well, there should be a multi-year positive boost for the industry.
Mohit, how are you looking at your workforce at Tech Mahindra? Any reason to think that there might be job cuts, whether it's because of AI or some other factors?
Well, I don't think that AI will lead to job cuts for the industry, at least the way we understand the opportunities just now. I feel from a Tech Mahindra perspective, the imperative to train is very important. And in this, we're helped by the fact that not only do we have our internal training programs and setup, we also have a full-fledged university in Mahindra University, which has over 8,000 students just now, a multidisciplinary university, because multidisciplinary is the approach that you need for AI training. I also feel that we have a much more experienced workforce than our peer group or really the system integrator average. The average experience of our teams is about 9 to 10 years. And really, when AI helps drive the developer productivity, I feel this experience pool will be a huge asset for us. So we're very optimistic about the opportunities that AI will bring, to our industry and to Tech Mahindra, because so much of the work needs to be done to help our clients get the benefits from a productivity perspective and from a revenue perspective.
You talked about training. Are there challenges internally to training your high-level, mid-level workers?
Really, look, I think the thing is that because this is partly top-down, but a large part of it is bottom-up as well. If you're a developer, if you're an architect, you want to learn the latest technologies. You want to be at the cutting edge so that your own resume, your own profile, your own experiences are up to date. So it's partly us making our teams aware of the learning opportunities available, whether it's within Tech Mahindra or through Mahindra University or through our ecosystem of partners, including a Microsoft and Amazon or a Google. But a large part of it is also the teams pushing us because they want to learn the latest technologies. They want to be more productive and they want to be much more useful and have a differentiated capability set for our clients.
Mohit, some of your larger rivals have said that they're holding off from spending and investing, given the lack of clarity in the investment environment. I'm just wondering, what are you hearing from your own clients?
Look, I think, the clients are, and it's only partly because of AI. It's partly because of the uncertain economic situation. It's partly because of the uncertainty around tariffs. people have been holding back on large capex decisions, and some industries like telecom, for instance, have been going through a period of stressed economic climate. We do feel that is going to be changing. That is going to be changing in the second half of the year, and growth should come back to enterprise spends and to technology services. I do feel that a significant, like I was saying, backlog of work in terms of modernization, in terms of optimization, should give a secular tailwind to the industry and to technology spends in the whole. From our perspective, while we have ruled out large M&A, this was almost about 2 years ago, we do continue making very steady investments in terms of training, in terms of sales force, and in terms of our infrastructure.
As you said, tariffs are a huge factor for a lot of economies as well as companies. How are you looking at the escalating trade tensions within the U.S. and India now that India could be facing tariffs in excess of 25%?
If you look at our business, I would say well over 90% of our business really caters to international clients. Within Tech Mahindra, we do have a very broad-based distribution of revenue across geographies. Over half of our revenue is from the Americas, about a quarter is from Europe, and then a quarter is from India, Middle East, Africa, and Asia Pacific and Japan. Indeed, I'm speaking to you from Australia today, which is one of our fastest growing markets. So given the wide sectoral and geographical distribution of our business, I do feel we're relatively shielded. Clearly, there are some areas of stress. For instance, our automotive business, because of the uncertainty around tariffs globally, our clients there have been stressed and have been sort of delaying some of their capex decisions around technology. But on the whole, given the the widely distributed nature of the business from a geo perspective and from a vertical perspective, we do feel relatively comfortable.
Given that you are comfortable, Mohit, any appetite for M&As?
Well, look, we made a decision about 18 months ago in terms of our capital allocation policy to give 85% of our free cash flow back to our investors. That has been very well received. We have no intention of changing that policy at this time. There's obviously a small tuck-in M&A that we keep looking at, carve-outs from our clients that we keep looking at, and that work will continue, but not looking at transformational M&A at this time. And that actually, I know you've been showing the 1 year picture from a stock price perspective, but if you look at a 2 or 3 year perspective, it does show a significant boost from the investor confidence in our strategy and in our capital allocation policy.
Any revenue targets you can share with us?
Our revenue goal is very clear, right? It is to grow faster than our peer group in FY27. We have already, I think we're in the middle of the pack among our large peer group in terms of growth, and we intend to overtake that over the next 12 months. A huge amount of our focus has been on margin expansion, and we've now had 6 consecutive quarters of margin expansion, which we're really happy about. Our large deal pipeline, right? And our large deal pipeline, to a very large degree, reflects our confidence about future revenues. Our large deal wins at about 800 million plus or so in the quarter we just reported has been going up consistently for the past 5 quarters. The average size of the deals has been increasing. The average profitability of the deal is very healthy. So that gives us the confidence from a revenue and margin perspective as we work very hard towards achieving our FY27 goals, which has made us the best performer, at least till about a week or so ago. I haven't checked the latest numbers from a 1 year and a 2 year total stockholder return for our investors.
Great having you with us, Mohit Joshi, CEO and MD of Tech Mahindra. Thank you so much for that. Still to come, why pressure on the rupee may persist despite today's RBI rate decision as geopolitical tensions and trade risks cloud the central bank's outlook. A preview next. Keep it here with us. This is Bloomberg. It is RBI decision day, and the central bank is expected to hold rates. Bloomberg Economics says June's shift to a neutral stance means the bar for future cuts is now higher. Let's bring in our senior India economist, Abhishek Gupta. Abhishek, what are you expecting from the RBI today? Because there are those who say that it should cut rates today.
Thanks for having me on the show, Haslinda. Today's policy, we are expecting a rate hold after the RBI has delivered 100 basis points of rate cuts earlier in the year. But as you said, the bar for further easing has been raised higher by the RBI's own action of the June policy, where it kind of sent a very confusing and mixed signals to the markets by delivering a larger than expected 50 basis points rate cut, but it also took a hawkish forward guidance by changing its policy stance to neutral from accommodative. I think in terms of what it's likely to do today, or what will be on the top of its mind, would be to undo some of that hawkish forward guidance, but at the same time, it will also be concerned about the downward pressure on the rupee. Its policy rate differential with the Fed is now back to its record low of 100 basis points, and that would be something that would be playing on the mind of the RBI as well. So our base case remains that RBI will deliver a dovish hold. It is likely to lower its inflation forecast while retaining its growth forecast. But it will highlight downside risks to growth, given the fact that India now faces 25% reciprocal U.S. tariffs, and the pressure from Trump on that side is only increasing over the last few days. So it remains to be seen what the RBI comes out with, but our base case remains for a hold.
You got to question where the RBI goes from here, especially on expectations that those tariffs go higher from 25%.
I guess all of that clarity would be available to the RBI and to the markets only after the policy is concluded today. When the RBI has been meeting over the last few days, the tariffs as of that day remain at 25%. Our own calculations show that if a 25% tariff kind of persists on India, that could lower India's GDP by about 0.6% over the medium term. My sense is that the actual damage to growth could be even higher because it is likely to dampen India's ambitions of boosting its manufacturing sector and trying to integrate its industrial sector into global supply chains. I don't think RBI is going to act on a hypothetical scenario where the tariffs could be more than 25% and the hit to growth could be much more severe. So RBI would probably wait for that clarity, but in the meantime, it is likely to just highlight that there would be downside risks to growth. But at the same time, one also needs to take into account the positive domestic factors which are supporting growth. We are going to have a bumper harvest this year, again, following good rains this year, which will support rural recovery and overall growth.
Abhishek, thank you so much for that. Bloomberg senior India economist Abhishek Gupta there. Subscribers can also turn to the terminal for more of our RBI coverage. T-Live Go is your function for the updates, plus commentary and analysis from our expert editors. By the way, we're keeping an eye on Cathay Pacific, out with earnings right after the show. It is expected to post first-half revenue and also operating profit that's higher. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.